Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
This podcast was recorded for publication on the 24th of April 2025 by HSBC Global Research. All the disclosures and disclaimers associated with it must be viewed on the link attached to your media player. And remember to like and subscribe to the Macro Brief wherever you get your podcasts.
Hello, I'm Piers Butler and welcome to the Macro Brief, our weekly look at the issues driving financial markets across the globe. As market uncertainty and volatility continue to rattle investors, one asset that has seen a big rise is gold. Prices surged to a record high earlier this week, topping $3,500 per ounce. And although prices have fallen back since then, bullion is up over 20% from the start of the year. So to look at what's behind the surge and where prices could go from here, I'm joined from New York by James Steele, our Chief Precious Metals Analyst. Jim, welcome to the podcast.
Thank you, Piers. Thank you for having me.
Well, we were very keen to have you on the podcast, given all the headlines that we keep seeing on gold. And in some respect, I guess it's understandable, given its traditional safe haven role. But we are talking about multi-year highs, which few, I guess, would have predicted. Perhaps to sort of put it into context, how high is gold in real terms? I mean, adjusted for inflation.
Yes. Now, gold has, as you quite rightly say, gold has made a series of repeated highs in nominal terms all this year, and in fact, last year as well. But gold has only recently hit highs in real terms. The previous high in real terms was January of 1980, when gold hit $850 an ounce. And that was the same month that Volcker was appointed to the Fed, and it was in the waning days of the Reagan administration took over. Now, if you use the CPI deflator from the Department of Commerce, that puts gold at just a shade under $3,400 an ounce. So this week, when we went above $3,400 an ounce to touch $3,500, we went into not only real highs in nominal terms, but also in real terms.
So let's try and understand what's driving this. Because as you say, when you look at a chart of gold in real terms, it's taken a long time to get back to this previous historic high. You talk about the fact that there are, in fact, 12 to 15 factors that tend to drive the market for gold. But the trick is knowing which ones are in the driving seat. I guess one of the important ones at the moment, and has been for a few years now, is geopolitics.
Yes, that's absolutely correct. Geopolitics is central, I think. Geopolitical risk and the rise in the geopolitical risk thermometer globally is central to why we're so high right now. And, analyzing geopolitical risk and gold, it's very interesting because, you can say to me, Jim, what happens to gold if the Fed cuts 100 basis points? Or what happens to gold if the dollar depreciates by 2%? Or what happens when the equity markets do this? And I can go back and I can look at the empirical information, the data, and I can come up with some sort of an idea. But quite frankly, this does not apply. You cannot model geopolitical risk in the same sense. Ukraine is different from Gaza, is different from the issues in the South China Sea, et cetera, et cetera. So it's very difficult. It makes any kind of quantitative modeling virtually impossible, except that we do know that when geopolitical risks rise, it obviously has a negative impact on capital markets and increases the demand for safe havens, principally of which is gold.
And Jim, you also say in your report that debt is a friend of gold. Why do you say that?
Well, yes, that's right. And I think we have to make a distinction between private debt and public debt. Private debt is my debt, it's your debt, it's the debt of a company, be it a large multinational or a small corporation, and the gold market is relatively insensitive to that debt. And I think movements in that debt, and I think that's because the gold market is populated by free marketeers who believe that if Jim Steele borrows too much or if a company borrows too much, one way or another, they'll be restrained. The market will punish them. Whereas we all know that governments have more largesse, don't we? They can borrow, particularly G10 governments, can borrow much more. And gold is sensitive to that, partly because too much government debt can impact the capital markets, dislocate the capital markets. There's the crowding out theory that you don't get enough private investment. It can be inflationary, it can be monetized. And all of those things lead us to search for greater safe havens and hard assets, of which gold is number one. And if you look at recently, the IMF have warned about the increase in debt to GDP ratios worldwide.
Clearly, the other factor, more recent, is the current economic environment with dramatically increased uncertainty. Is that why the relationship between gold and real yields has broken down? I mean, traditionally, as you have written, when you get high real yields, that tends to be not so good for gold. But that relationship seems to have broken down recently.
Yes, it has. And in fact, one of the most, when you're an analyst and looking at something like gold, you search for relationships. You look US dollar, gold, treasuries, gold, equity markets, et cetera, et cetera. And one of the longest lasting relationship was the inverse relationship between real yields on the US 10-year specifically and the gold price. And when we went negative, when real yields went negative, such as during global financial crisis, during COVID, gold market did very well. Periods when it went positive, the gold market tended to weaken. That broke apart towards the end of 2022. And I think there were a number of reasons for that, but namely economic policy uncertainty because of increasing inflation. This is when you also got large central bank buying and very large retail coin and bar buying as well. But further to the point of economic uncertainty, we looked at the economic policy uncertainty index, and we found a decent correlation with gold. And what I want to stress here is not so much economic distress. One can argue if an economic policy is good or if an economic policy is bad, depending upon your view. But what the gold market really latches onto is uncertainty. And let me just take a brief view to history. One could have agreed with Mrs. Thatcher and Ronald Reagan, or one could have disagreed with them. The fact of the matter was that they had great clarity with their policy. Everybody knew what they were going to do. Currently, the economic policy climate in many countries is not clear. And this is what's driving the gold.
So with all this rise in nominal and indeed real value of gold, how has this impacted the physical market for gold? And is it fair to say that as HSBC, we are particularly well placed to have a view on this?
Yes, indeed. And not wanting this to be a party political broadcast for HSBC, but we stand really at the head of this combination of the investor market and the paper and the physical market. We're deeply involved. We're a major exporter to China and India, who consume 50% of the world's gold between the two of them. Also jewelry, refining, recycling, mints, mines. We are involved in this, and through hedging and managing, we're able to have a feel for the rhythm of the physical market. And I'm glad you brought it up because it's something that's not being talked about. We are seeing outright demand destruction because of the high price. Jewelry demand is down double digit. That's 50% of all physical gold demand. And I'll give you an example. The 10-gram bar, not very big, is the favored bar in India, major consumer of gold. It was 35,000 rupees just a few years ago. It is now around 100,000 rupees because the rupees also weakened to the dollar. So this is pricing gold out of the market. Now, this doesn't matter as long as there are plenty of investors to absorb this gold. And that has been the case so far. But coins are coming back into the market. The demand for small bars is falling and the demand for jewelry is dropping.
When you say that there's still been demand, is that because of the creation of ETFs and gold ETFs have been enormously popular?
Yes, they weakened for quite a number of years. They hit, and we were at the forefront of creating the world's first gold ETF with the World Gold Council. And we store a large portion of the world's ETFs in our vaults. It was successful, very successful up until COVID and through COVID, and then dropped, but have come back at the beginning of this year. And also we've seen an increase in Chinese-based ETFs. And all of this is adding to the investor demand.
So a bit of a curveball here, but why have millions of ounces of gold shifted to New York warehouses? That seems like a bit mysterious.
Well, yes, and the last time it did, and this is where it gets a bit technical because you talk about the exchange for physical market, the EFP market. This happened during COVID, by the way, when it looked as if U.S. gold refineries were going to close, or we weren't going to be able to get enough pilots to bring the gold from London to New York. London is the center of the physical market. New York is the center of the futures market on the old COMEX, which is now called the CME. And if you get a threat of tariffs, in this case, which was a possibility of, say, 10% tariffs going on bullion coming out of London, that would have thrown the physical price up 10%. It would have created a massive difference between the EFP. And therefore, in order to safeguard that we would have enough gold to meet these contracts, millions of ounces of gold shifted from London and other places into New York. Now, the EFP has since come in because it's quite apparent that bullion has had exemptions to the tariff. But we didn't know earlier in the year, and consequently that gold flooded in. It is now beginning to move back out, which it also did during COVID, by the way. It came in and then it moved back out again.
So, Jim, it's fair to say you're still a young man, but you have looked at precious metals and gold in one way or another over the last 40 years, and I'm sure you've seen many ups and downs. But how significant is the current price spike in the context of all that history?
Well, it's taken quite an emotional, physical, and mental toll on me, as you can imagine, Piers. But it is a fascinating market. It is intellectually, it's very, very challenging. And there's very few markets where you can move all the way from fashion and design and adornment through investment, through geopolitics, through macro and microeconomics. It's got the whole thing. And what is interesting is that gold is a barometer for global events. And if one looks at gold, one can see how the investor public is reacting to government policies, is reacting to what is happening in the world. I'll point out in the 1990s, gold was very weak. And there's no doubt that the end of the Cold War and the reduction in geopolitical risks contributed to that. Well, in the last few years, those risks have been back up. So an observation of the gold market really puts you in the eye of the storm, if you like. And that's why I think it's such an interesting market. And despite the fact that many other physical things have gone by the by, gold is still useful for portfolio diversification.
Okay, so toughest question last, Jim, but where do we go from here?
Well, I think we're going to see, I think the last couple of days showed us that any positive comments, and we got some positive comments on trade, on tariffs coming out of the White House, and also a pullback from criticism of the Fed and retraction on the White House calling for Powell's dismissal. And then the gold market dropped very quickly. Overnight, we've seen perhaps less progress on the trade issue coming out of China than had been hoped for, and the gold market has come back again. So I think we're going to be very sensitive to headlines, and we have to wait for the geopolitical risk thermometer to calm, whether that be a settlement in Ukraine, whether it be some progress on tariffs over time, and that will be the driver of gold coming lower. And that will be when the heavy increase in the physical side of the market through a lack of demand and increased supply, by the way, will begin to weigh on prices. But until then, we're going to be powerful and volatile.
Jim, that's a great insight, and no doubt there'll be many more twists and turns in this market. But for now, thank you very much for joining us.
Thank you.
Hello, Macro Brief listeners. Fred Newman here in Hong Kong. The tariff story clearly isn't going away anytime soon. And as always, we've got our finger on the pulse here in Asia. Join me in a room full of my fellow economists on this week's episode of Under the Banyan Tree. We'll be discussing the outlooks for Japan, Korea, Taiwan, Vietnam, and many more economies. That's Under the Banyan Tree from HSBC Global Research. Find us wherever you get your podcasts.
Before we go, a reminder that HSBC clients can keep up to date on our latest research by downloading our app from Apple's App Store or Google Play. You can get in touch with us if you have any questions or comments about the podcast. Just email askresearch@hsbc.com. And finally, a quick note about another series of podcasts from HSBC. Recorded behind the scenes at our Global Investment Summit in Hong Kong, Perspectives features conversations with special guests on topics ranging from trade to AI. The latest edition includes Global Research's Paul Mackle and Stephen Major talking about developments in the currency and fixed income markets. To listen, just search for HSBC Global Viewpoint wherever you get your podcasts. And don't forget to subscribe to the Macro Brief while you're there. So that's all from us this week. From all of us here, thanks for listening. We'll be back next week with another edition of the Macro Brief.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.